markets have tried to price the risk of what's going on in the Iran-Israel war, the 12-day war. I think oil markets really and oil traders had priced it appropriately. And right now we seem to have moved to a place where investors think that the worst is over. I don't necessarily subscribe to that perspective per se, because we will see how Donald Trump pushes the next phase of the Iranian agreement. It's clear that he's had a great week so far, coming very strong from NATO, having had a ceasefire in Iran and Israel. But I think investors who had always been wary of geopolitical tensions and risks within the region have once again understood that they need to price risk a little bit better perhaps when looking at volatility. Also with the context that this is not an isolated incident. I mean, we are in the middle of systemic shifts and cycles when it comes to politics, macroeconomics, and geopolitical cycles. But for the moment, the worst seems to have passed. I think we will be looking much more towards the trade tariffs plus the tax bill coming up over the next week and 2 weeks then.
Ozan, as you say, it seems as if market sentiment is now shifting back to market fundamentals in terms of sentiment and direction. You mentioned that, of course, when we look at the conflict in the Middle East, the opportunity here is in the volatility. So walk me through how investors should be positioned right now. Of course, investors love a buy the dip story. So what are the sectors or asset classes that are perhaps looking the most full of opportunity? What looks most vulnerable right now as well?
I think it's all about resilience and building resilience into portfolios and also economies. And what I mean by that is particularly we have witnessed once again the fragility of the global energy infrastructure. So therefore investing in energy infrastructure both in Europe, in the Gulf, in the world is a good bet. Alongside certain other asset classes, I would say, like agriculture, water security, defense obviously. So the opportunity really lies in trying to understand how the energy spectrum is going to shift. Again, I don't think necessarily the worst is over, and I don't think this is an isolated incident. So there's opportunities in being able to invest in more thematic assets and more thematic kind of plays along the way. At the same time, when we take a look at the risks and how we hedge against those risks, I think GCC investors are really well positioned then because of the strong fiscal position of GCC countries and also sovereign wealth funds looking to diversify out and away from the commodity play anyway, which they're doing a great job with. Looking at kind of where the growth will come will be, I think, much more important going forward for investors, whether that's US markets, innovation, how tech innovation is going to lead the way, or whether it's potentially, for the first time in a long time in Europe, which has lagged the US, with the fiscal stimulus programs coming to also gear up Europe's defense posture into a much higher level, European markets may end up attracting more investment as well. But I would outline the thematic plays as energy infrastructure and security, defense, agriculture, and water security.